Thanks very much, Paul, and welcome for today's webinar. So let's start with, what are the experts saying? So as you would have heard over the last few months, the economic data is the worst on record. So, as it says here, the world economy will experience the worst recession since the Great Depression. Global crisis, both advanced economies and emerging market and developing economies are in recession. Major economies have also been significantly downgraded, and this data is from the IMF. The one thing to take into consideration here is that the economic data that we display here and the economic data that we receive and speak about is all backward looking. So as an example, you're sitting at home after dinner or whatever the case may be, and you've got the news on and they're talking about the GDP figures, or they're talking about the unemployment figures. Those figures are not today, they are then for the previous quarter. And so that's an important thing to recognise, because the data that we're seeing at the moment, whilst we know at this point in time is, and I'll take you back over the last month or two, when the whole country is in lockdown, the data is not going to be great. And so when you do have people working from home, or some people that can't work from home, or some people that have lost their jobs, the data is not going to be fantastic. So what's happened as a result is that the market has started to see through this and say, the market is forward looking, and the market looks through this to say, well, okay, well, we know where we are today, but where are we heading in the future? And the economy can turn around quickly. And I do like this graphic here, quite simply for the fact that it talks about declines. So when we have a structural decline, so a structural decline as an example was the GFC. In terms of a decline, in terms of markets and the economy, we saw a reduction there of 55%. The average length of recovery, the average length that we were in that period of time was between 40 and 45 months. And the average time to recover was anywhere between 100 and 120 months. Now, the current event that we are going through at this point in time is not structural or cyclical in nature. It is more of a one-off event-driven event. And as a result, when you look at the previous history of event-driven events, what happens? Well, the average decline is significantly smaller. You have the actual average length of it is shorter as well, and the average time to recovery is also shorter. And we're starting to see this. And by looking at the next slide, one of the common questions that we get as advisors, well, what's the recovery look like? Is it V? And pick a letter of the alphabet. Is it V-shaped? Is it U-shaped? Is it the old Nike swoosh shaped? Is it the Z-shaped? Now the Z-shaped is much like a V-shape, but it then continues to outperform, and then it comes back down again, quite simply because the economic spending that the government's been, or the stimulus that the government's been throwing out there, has actually started to wear off. Is it W-shaped, or is there an L-shaped recovery? So these are all important questions. And the one thing that I would say is, in the current environment and the way that we see it at this point in time, and I'll take you back to the previous slide, is that because it is event driven and people think, well, okay, look, we have been at home, but we are getting back to work. I'm up here in Queensland at the moment. Paul's in New South Wales, and the majority of our clients that are on today are in, whether they be in Victoria or just southern New South Wales, Albury. You can see that, well, Queensland's opened up. I won't say business is back to normal, but we have certainly got restaurants open, and where we can have 20 people sitting down and having lunch or dinner or whatever the case is. We do have things that are starting to get back to some sort of normality. Not the way that it used to be 3 or 4 months ago, but starting to get back to that. And the markets are actually seeing that. And they're seeing that globally. So this is something that I put into the slide pack probably about half an hour before we kick things off. This is an article from this morning. So the S&P 500, the US market, has wiped out the losses made in this financial year. So as of close of business last night or early this morning, the S&P 500, the US index, is at the same point as it was on the 1st of January. So if we're looking at 2 points, the 2 points will say that from 1st January to where we are today, it was just a flat line. So that is really interesting, quite simply because it means that people in the US are saying, well, okay, look, I get what's happening at this point in time. I'm talking in our financial sense, and that things will start to get better and over a period of time. Now, over that period of time, we're not sure what period of time, but they know that things will get better sooner rather than later. And it's important to note that the share market is not a reflection of the average small business. So if I owned a coffee shop and I had 6 employees, we can all understand the fact that when we go from sit down service to takeaway service, I don't need 6 employees, so I've got to let a few employees go. When we then had to shut up shop, as an example, then there's nobody working whatsoever. When we start to open and you can only have 10 people in there, well, maybe there's no need to employ 6 people. So it'll just be myself and my partner as an example. And from there, we'll start to employ 1 and 2 and then 3. And we may not get back to 6 people for another 12 months. That is small business. Larger businesses, different story. So larger businesses, and as you can see here, you've got the Microsoft, the Apple, Amazon, Alphabet, and Facebook. They make a significant portion, of the US market. And these are big companies. I mean, they have capitalization greater than a fair chunk of countries out there as well. So when, as an example, if Roy's working from home or Paul's working from home and we have a discussion amongst the business from a leader's perspective, well, okay, look, Paul, look, if you're going to be working from home, we'll give you a new a MacBook to work from home, and we'll put Microsoft on there as an operating system or whatever the case is. You're using Google or Alphabet. People now being at home, they're shopping more, and especially in the US, Amazon's the #1 place to go, and so on. So these companies are big companies and they are still profitable and they're making a lot of money. And that is where we've seen that recovery in the US. And so if you go back to, and they used to be called the FANGs, but there's a few more companies in there now. These tech companies have certainly led the US market back to a recovery that is more V-shaped than the other type of shapes.
That's a great insight to how the markets and businesses work. We all watch the news and see the horrible and terrific and terrible things going on in America at the moment. But the stock market keeps going up. People are still seeing a positive future. It just shows the complete difference between what the economy is doing and what the market's doing.
And very much so. And that's where the market is forward looking. So whereas the economy, when you listen to economists and you listen to the data is all real data, but it's looking backwards. And so therefore it is important to say, well, okay, from an investment point of view, what am I looking to invest in? I'm looking to invest in the greater good of Australia or the world and these companies. And I want to be an owner of these businesses because they're fantastic businesses with great balance sheets. So if I'm an owner of these businesses and I know they're going to make money, well, I want to be a part of that. Whereas, if I've got my coffee shop, yes, that's me, that's my own, but, this is somewhere where else I can make money. I can make my money work harder for me.
And that's what adds that real level of complexity, understanding what's going on in the local economy or even the global economy isn't what's reflected in the investment economy. So people are still putting money in and making money, even though global economies are going backwards.
Correct. And those global economies will recover, and they will recover, and it's just time. Okay, and as it always has been, some will recover better than others, and there may be changes towards the top of this country is doing better than this country or whatever. But you've got to look at the underlying companies. You've got to look at the business models that they have. You've got to look at the way they operate, the balance sheets, the cash flow, and take all of that into consideration. And from an investment perspective, this is what we do on a day-to-day basis as part of the investment committee: is look at this in detail. We then provide this information to our advisors at RJS, and these are the investments that we say, well, okay, this is where our clients should be invested in, or these types of investments. And that's where the RJS advisors, myself included, where we sit down with clients and say, well, okay, look, based on your circumstances, based on your strategy, then based on the investments that we're looking to undertake, this is what we're going to invest in.
Yeah.
And all markets aren't created equally, so tread carefully. Goes to the point before. So, US and European companies are financed differently, and there's been a rising funding costs in emerging markets as spreads have recently blown out. Just something to be aware of. So we look at that and say, well, okay, here's a good place for us to invest at this point in time. Now that won't be the same place in 6 months' time. And that's why it's another reason it's important to seek advice on a regular basis and meet with your advisor on a regular basis to say, well, look, am I still on track to where I need to be?